Investing is not all about shares and price growth. Even within the stock market, there is a range of asset classes and investment strategies for you to choose from. Outside of the stock market, there is property, peer-to-peer lending, crypto, bonds, and all sorts of assets to choose from.
In this video, we discuss the elements of a well-rounded portfolio and how you can balance yours. Let's check it out. Welcome to Money Unshackled, the investment channel that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe. Let's get into it.
Why you shouldn't over-diversify. Balancing your portfolio doesn't necessarily mean diversifying it to the max. Diversification is the process of spreading your money thinly across many assets.
But if you diversify too much, you will be reducing risk, but perhaps at the expense of potential returns. A well-rounded portfolio of stocks may consist of 20 stocks chosen for their specific qualities. Those qualities could be capital growth, dividend income, and reliability, just to name a few. If you buy too many of an asset, you could end up just tracking the market, as you end up with a representative sample of everything.
Capital growth versus dividend income. Whatever asset class you are investing in, you might want to balance your potential for capital growth versus income, be that from dividend income, rental income, or interest. You may have a preference towards one than the other. We, for instance, value cash flow income more than capital growth because you can actually live on cash flow. But as a secondary consideration, we also want to know that there is some potential for capital growth.
In the case of shares, you may want to hold 15 stocks with a high dividend yield and 5 that have the potential to offer capital growth.
Reliability versus opportunity. You may want the bulk of your portfolio to be weighted towards either cash flow or capital growth, depending on your preference, but why limit your opportunities? If you're a property investor and your strategy is to buy city centre flats to rent out, then why not also buy some in a different city, for example, or buy a detached house? You never know which of these investments will work out over the long term.
If you are investing in shares and only investing in the big, safe companies, then perhaps you could consider investing in smaller companies that offer a greater potential for risk. We think you can be too safe by investing in these relatively safe companies, as they generally offer a lower potential return.
A well-rounded portfolio. Here is an example of a well-rounded portfolio. The first thing you will know is that there is a wide range of asset classes in this portfolio. This person has the bulk of their wealth spread across stock market tracking index funds and rental property, both of which are well known for their steady capital growth and reliable cash flow.
They have also invested in the stock market directly through shares, though the majority of their paper assets are in diversified index funds.
Within each slice, the rules we have just discussed will hold true. Within the shares slice, they will own around 20 stocks, which will be deliberately selected for their qualities. Within the property slice, they will have a range of property types which cover both income and capital growth. And within the index slice, they will cover emerging markets where growth is expected to be higher, and established markets like the UK and the US.
Going back to this example portfolio, we also see that this person has invested part of their wealth in peer-to-peer lending, a primarily low-risk, cash-generating asset class, and crypto, a purely speculative capital growth asset. They are balancing their risk, reward, growth, and income between asset classes.
Also note that 10% is in cash. You might scoff at the thought of holding so much of your wealth in useless, inflation-assassinated cash, but this is for two reasons. One, to protect against unforeseen issues such as loss of income from a market crash. And two, so that when fantastic investment opportunities come along, you are ready with cash to take full advantage.
Risk versus return, many assets versus expertise. Now, as you might know, Ben and I both have our own areas of expertise where we feel most comfortable in attaining those high lifestyle supporting returns. Ben prefers to hold the bulk of his investments in property, whereas I prefer index funds and shares.
We are on this journey with you and are currently building our own freedom funds to balance income, growth, risk and reward. That said, this is what my ideal portfolio might look like once it's properly established. This portfolio is still well-rounded because the growth versus income and risk versus return rules within asset classes still hold, but we've factored in expertise. Whilst we don't think any investors can truly be experts, property is the area that most interests me and the model that I know best. I still only want half of my total portfolio to be property, but it's weighted in this direction.
While my area of expertise is in the stock market, here's an example of a portfolio that people who are confident investing in the stock market might choose, with the bulk in market tracking index funds. The portfolio has particular focus on high dividend cash flow and stocks that balance cash flow against capital growth, with some exposure to other asset classes like cryptocurrencies amongst them. This person's well-rounded portfolio might also include some property for the reliable cash flow it offers.
Conclusion. It's not all about shares, but about holding a range of assets with built-in plan Bs for when your main strategy fails you. And within any asset class, maybe aim for an 80-20 split between your primary goal and your secondary goal, maybe 80% cash flow and 20% capital growth. Also, check out our promotion links in the description below, which includes a £50 cashback bonus reward if you sign up to a peer-to-peer platform, alongside other ways to support the channel.
Question of the day: do you invest in multiple asset classes, or do you put all your eggs in one basket? Let us know in the comments section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is Money Unshackled. See you next time.